Hey, how's it going, everybody? Welcome to another video. In this one we're going to be talking about auto loans and how to figure out how much your auto loan's actually going to be costing you. In another video we'll do leasing versus purchasing, but in this one we're just going to talk about auto loans. So of course you can see in the description below all the links that we'll be talking about today. Some considerations for this video is that all numbers being used are pulled from the national averages, and for simplicity the person in this example paid the sales tax out of pocket. Alright, so auto loans can be fixed rate with amortizing payments, meaning you'll be paying more interest first. Another thing to know beforehand is whether you're going to have a trade-in or not, what it's worth, and then some questions to consider for this video are going to be, is it more beneficial to put a larger down payment or to take that money and spread it out over time to make your month-to-month payments bigger? So we'll look at that at the very end. So this example has a $25,000 vehicle, whether it's brand new or lightly used. We're going to pay 10% for the down payment, $2,500, and we're going to have a $3,500 trade-in. So total, we're going to have $6,000 off the purchase price of the vehicle, bring our loan to $19,000. We're going to have a 3% annual interest rate, and we're going to pay the loan off within 6 years with a monthly payment. And then of course vehicle depreciation is a pretty big factor when it comes to figuring out what car you want and when you want to buy versus sell and everything like that. So we have 19% and 15% after that for each additional year. Brings us down here. So we're going to have just under $300 monthly payment at the 3% interest rate, $19,000. And we're going to end up spending just under $1,800 total in interest. So if you watch some of the other videos with credit cards, $1,800 might not seem that extreme, but that's because we're paying it off within 6 years instead of 26 years. But there is still ways to optimize the interest being paid. And let's go down here and look at vehicle depreciation. So this is probably a much bigger factor than the interest being paid. You have your first year, you're losing almost $5,000 in value on the vehicle, and then after that you're averaging about $2,500 to $2,600 in vehicle depreciation. So by the time the vehicle is finally paid off, you will have lost $15,500 in value of the vehicle. And so at the end of the 6 years, the vehicle will be worth just under $10,000, and you will have spent or lost value totaling up to $17,000. So while $1,700 in interest might not seem like that much, the depreciation itself is really what's killing us, which is why most people don't consider vehicles to be an investment, more of just a living expense. Alright, and then of course with this link and example, you can look at the amortization schedule, and you can see here interest versus principal, how much your payments are. Remember with amortizing payments, the payment always stays the same. Principal, what you're paying on the principal goes up, and what you're paying on interest goes down, all the way to the bottom. Alright, so you can play with that. You can play with how many years the loan is going to be and how that's going to affect everything. So feel free to mess with this calculator and see what kind of loan you want to try and take out. Alright, so for the examples we talked about, for the questions I should say, you have the example we just went over, $1,700, almost $1,800 in interest, $17,000 total between loss of value and between the interest being paid, leaving you with a vehicle that's worth just under $10,000 after 6 years of ownership. Alright, so let's say you put a large down payment, which 30% or $5,000. So you have $5,000 in your savings, and you're like, do I put it all in the car? Is it really going to be worth it or not? Alright, and if you look at it, you're only going to save yourself about $450 in interest being paid. So after 6 years, you will have either spent or lost the value for a total of $16,800, but your vehicle is still going to be worth the same because you decided to have a 6-year loan. If you look down here for increasing your monthly payments, so you keep that $5,000 maybe as an emergency or just in case. So instead of putting it all up front, you're like, oh, I'm just going to increase my payment $70 every single month. And what that does is it reduces the life of the loan to 4.7 years. So your interest is lower, which is nice, right? Saving yourself another, $120-ish here. But the biggest thing is, if you look here, since it's only 4.7 years, the vehicle did not depreciate as much. So you're losing $14,500 between interest and depreciation, but after 4.7 years, your vehicle is still worth, $11,600. So if you're considering a large down payment or paying off your loan faster, just based off this example, I would suggest paying off your loan quicker, so that way maybe, you do want to buy a new car, and, or whatever you decide you want to do, your car or your vehicle will be worth more, the less time you spend waiting. So do with this as you will, play with the calculator, kind of figure out how much you're willing to increase your monthly payments by, and of course, look at your overall budget and see what's realistic for you. So as always, if you guys have any questions, feel free to ask, and yeah, hopefully this video helped.